96% of your paying gym members never show up. And that's exactly how you make hundreds of millions of dollars a year. At first glance, those monthly profits make it look like a quick way to get rich, yet 90% of US gym owners still go broke in their first year. Not from a lack of members, but from bleeding their profit margins dry on $15,000 in insurance and misallocating capital into machinery. This is the dark side of owning a fitness center that nobody tells you about. To an institutional real estate investor or private equity analyst reviewing Item 7 of a standard franchise disclosure document, the financial proposition of a low-cost commercial gym appears almost magically frictionless. You are staring at an entry-level membership priced at exactly $10 a month, a price tag that has remained virtually untouched for over 2 decades, despite cumulative inflation eroding the purchasing power of the dollar by more than 60%. In an economic landscape where a basic morning coffee can easily command $7, offering unlimited access to a multi-million-dollar fitness facility for $10 a month sounds less like a profit-seeking enterprise and more like an act of corporate philanthropy. From a pure top-line perspective, this $10 price point operates as a masterclass in behavioral loss leader pricing. It sits comfortably below the mental threshold of spending scrutiny, transforming the purchase from an incremental service contract into an impulse buy. However, when you subject this model to a rigorous asset-level audit, the underlying capacity utilization numbers reveal a structural absurdity that defies basic physical reality. Consider the operational geometry of a standard suburban facility spanning 15,000 square feet. Under strict municipal building codes, local fire marshal restrictions, and occupational health standards, the maximum safe occupancy for a floor plan of this footprint, capped at any single moment, is precisely 300 people. Yet, if you pull the automated billing ledger from the facility's central database, you will discover that the location actively collects monthly recurring dues from over 7,000 active subscribers. Think about the sheer impossibility of those two metrics side by side. The facility has sold its physical footprint at a ratio of 23-1. If a sudden wave of collective discipline were to sweep through the local market on a rainy Monday evening, and even 15% of those paying members attempted to exercise simultaneously, the physical infrastructure would experience an instant operational cardiac arrest. The parking lot would back up into commercial arteries, law enforcement would issue immediate capacity violation citations, and the building would be forcibly shuttered. This extreme disparity between physical capacity and sold inventory is not a temporary operational oversight by local management. It is the fundamental financial engine around which the entire industry is constructed. Low-cost commercial gyms do not operate in the business of fitness instruction or physical transformation. They operate an automated real estate arbitrage machine that monetizes human inertia and quiet absenteeism. On paper, monetizing human laziness looks like the ultimate passive income machine. But when you step onto the operating floor, the structural friction begins to bleed your margins. According to the Item 7 disclosures in the franchise disclosure document for Planet Fitness, launching a single standard franchise center requires an initial capital expenditure ranging between $1,620,000 on the low end to over $4,920,000 on the high end. This is not the budget for expanding a multi-location enterprise. This is the required entry capital merely to open the glass doors of a single suburban location. A granular forensic audit of this initial outlay reveals exactly where that capital is consumed before a single membership card is scanned. Developers typically hand over raw concrete retail shells that demand extensive leasehold build-outs costing anywhere from $1 million to $2.7 million. An operator must install industrial-grade HVAC climate control systems capable of circulating tens of thousands of cubic feet of fresh air per minute, lay down specialized sound-attenuating rubber subflooring, and construct high-capacity commercial plumbing networks to feed rows of luxury locker room showers. Once the physical shell is transformed, equipping the floor with commercial cardio banks, selectorized strength stations, and free weights devours an additional $190,000 to $960,000. Above the physical build-out, state and municipal regulators impose severe legal friction. To protect consumers from pre-sale insolvency, major state jurisdictions legally prohibit a gym from collecting dues until it posts a health club surety bond, ranging between $10,000 and $100,000. Once the permits clear and the doors open, the business transitions into an unrelenting, high fixed cost operational marathon. The monthly operating expense structure is anchored by commercial lease agreements signed for 10 to 15-year terms with mandatory annual cost escalations. Base rent and common area maintenance, or CAM fees, command 25 to 35% of gross top-line revenue. Fully loaded labor costs consume another 25%, while 24-hour industrial power and continuous hot water utilities absorb up to 12%. On top of these local overhead demands, franchisors extract an unyielding top-line bite, a mandatory 7% gross revenue royalty fee plus a 2% contribution to the National Marketing Fund. Yet, what frequently cripples undercapitalized franchisees are not these predictable fixed costs, but the hidden operational bleed within the billing pipeline. Low-cost fitness models rely entirely on automated monthly recurring charges processed via credit card or direct bank account debit. On any given billing cycle, between 7 and 12% of those automated transactions fail due to expired cards, insufficient funds, or chargeback disputes. Each payment rejection triggers immediate payment gateway penalty fees and creates administrative friction that silently bleeds tens of thousands of dollars directly out of net operating income. Yet high fixed rent and payment rejections are mere paper cuts compared to the contractual landmine waiting in year 4. The magic of a low-cost commercial gym empire rests entirely on the illusion of simplicity. Underneath the $10 price hook and the slick motivational signage lies a meticulously engineered monetization architecture designed to execute layered upsells and extract maximum yield from consumer inertia. Consider the fundamental math of the $10 entry point. For over 20 years, this $10 fee has served as a frictionless psychological loss leader. It sits well below the threshold of monthly budget scrutiny, converting the sign-up from a calculated purchase into an emotional impulse. When a member inevitably stops attending in mid-February, that same $10 charge transforms into a cheap, recurring indulgence. It becomes a tiny monthly payment for emotional redemption, allowing the consumer to preserve the illusion that they prioritize their health without ever setting foot inside the building. This structural absenteeism enables extreme overbooking, allowing a facility capped at 300 people to comfortably bill 7,000 subscribers. However, the basic loss leader plan is merely the broad acquisition hook. The true gross margin engine operates through automated high-margin secondary layers embedded deep inside the membership agreement. Exactly 60 days after enrollment, and once a year every year thereafter, the billing system executes an automated annual enhancement fee of $49 directly against the member's account. Because processing an automated digital deduction requires virtually zero variable operational cost, requiring no extra electricity, staff labor, or machine maintenance, this fee delivers an extraordinary net profit margin approaching 95%. It represents pure, high-velocity cash flow funneled straight to the bottom line under the subtle narrative of facility maintenance. Parallel to the annual fee is the continuous push up the pricing ladder toward the Black Card tier at $24.99 per month. Corporate upsell funnels actively nudge members away from the $10 baseline by bundling the premium tier with low-cost, high-perceived value amenities. Members gain nationwide location access, guest privileges, and entry into dedicated lounge areas equipped with automated hydro massage beds and tanning booths. From an operational asset perspective, these premium perks are pure financial engineering. Hydro massage beds and tanning units require no dedicated labor to operate and consume minimal utilities. Yet this tier successfully captures roughly 62% of the total subscriber base and generates nearly 75% of all membership fee revenue across the system. by anchoring the consumer with a cheap $10 hook and smoothly upgrading them to a $25 recurring tier complemented by a $49 annual fee. The operator transforms a low-cost service into a massive cash printing machine. Yet this entire monetization architecture conceals a severe contractual landmine known as the mandatory equipment refresh cycle. When a franchisee signs a commercial agreement with a national parent corporation, they commit to rigid operational standardizations. These contracts explicitly mandate that the franchisee must completely replace their entire inventory of cardiovascular machines, every treadmill, elliptical, and stationary bike, every 4 to 5 years. Furthermore, selectorized strength stations and free weight arrays must be fully refreshed every 7 to 9 years. This contractual obligation creates a dangerous financial trap. During the first 3 years of operation, a newly built gym appears extraordinarily profitable. Equipment maintenance costs are zero, membership acquisition is strong, and cash flow looks pristine. If an inexperienced owner mistakes this early accounting profit for disposable free cash flow and distributes it to equity holders, they walk straight into a liquidity sinkhole. At the 4-year mark, corporate auditors inspect the facility and issue an unyielding directive. The entire cardio floor has reached the end of its contractual life cycle and must be upgraded immediately. The operator is suddenly hit with a non-negotiable equipment invoice ranging between $200,000 and $400,000. The existing machinery, despite meticulous care, has depreciated to near zero liquidation value. If the franchisee has failed to build a dedicated CAPEX reserve fund, they face an immediate liquidity crunch. They are forced to take on expensive commercial debt, dilute their equity, or default on their franchise agreement. The early profits were an accounting illusion, masking a massive delayed capital reinvestment liability. To see what happens when this delicate balance of high fixed leverage meets a systemic shock, we must look at the macro stage. In fiscal year 2023, Planet Fitness generated a massive total gross revenue of $1.07 billion, representing a robust 27.6% year-over-year increase. The top line was powered by its highly diversified recurring revenue channels, franchise royalties extracted from over 2,000 locations, equipment segment revenue generated by mandatory franchisee refresh cycles, and corporate store membership dues. Total operating expenses stood at $799.3 million. After accounting for overhead, interest service, and corporate taxes, the enterprise delivered $147.0 million in net income, yielding an exceptional net profit margin of 13.7%. In a brick-and-mortar retail sector where traditional operators struggle to maintain single-digit margins, converting small recurring membership fees into over $100 million of net profit demonstrates incredible financial efficiency during economic expansions. However, the exact structural features that make this asset class extraordinarily lucrative during economic expansions create extreme vulnerability when systemic disruptions strike. The true structural fragility of high fixed cost commercial models was laid bare during the crisis of fiscal year 2020, when mandatory public health orders forced more than 2,000 locations to lock their doors overnight. Corporate leadership froze all monthly subscription billing. The automatic billing pipeline feeding the entire enterprise was instantly severed. Total gross revenue collapsed by 41%, falling from pre-pandemic levels down to just $406.6 million. Yet while top-line revenue evaporated almost instantly, operating expenses remained bound by the rigid, unyielding nature of fixed overhead. Commercial gym models carry long-term financial liabilities that cannot be dialed back. Even with every facility standing completely dark and empty, operating expenses for 2020 totaled a staggering $422.9 million. Commercial real estate landlords still demanded monthly rent on long-term, multi-million-dollar leases. Corporate debt required regular interest servicing, and non-cash equipment depreciation continued to hit the balance sheet. The heavy operational leverage that maximized profits during good times inverted instantly, turning into a crushing financial vice. For the first time since its initial public offering on the New York Stock Exchange, Planet Fitness reported a devastating net loss of $15.0 million, plunging its net profit margin to negative 3.69%. Reflectively, the catastrophic swing from a positive $147 million profit to a $15 million net loss illustrates the fundamental vulnerability of high fixed cost commercial real estate models. When subscription volume drops below the threshold required to clear fixed overhead, an asset that once printed cash can transform into a catastrophic black hole of corporate debt in a matter of months. This dynamic reflects a broader macro pattern seen in large-scale corporate collapses, where a severe asset-liability mismatch intersects with rigid operational leverage. Consider historical corporate bankruptcies where enterprises entered long-term, non-cancelable commercial leases and heavy debt obligations, while selling short-term, low-friction services. When systemic shocks or shifts in consumer behavior hit the market, variable revenue drops to zero, while fixed lease liabilities remain at 100%. Here lies the fundamental lesson of scale in commercial real estate and franchise operations. Small, independent operators retain operational agility. If revenue dries up, a small owner can temporarily shutter operations, lay off staff, and eliminate variable costs to survive on minimal capital reserves. But massive megastructures bound by rigid commercial leases, strict corporate franchise agreements, and debt service ratios lack that flexibility. Scale is not an impenetrable moat in insolvency. When a business relies on high fixed leverage, expanding its footprint without building massive balance sheet liquidity simply multiplies its systemic risk. Reflectively, how does a sophisticated asset owner navigate this landscape without becoming another casualty of fixed cost rigidity? To transition into a true asset owner and insulate your capital from the rigid nature of fixed cost commercial operations, you must fundamentally restructure how you write lease liabilities and manage balance sheet liquidity. Instead of accepting a pure, flat base rent model that locks in high fixed obligations regardless of market conditions, sophisticated real estate investors negotiate a hybrid rent structure, combining a lower base rate with percentage rent tied to gross top-line revenue once sales cross an agreed breakpoint threshold. This creates an automatic operational risk-sharing mechanism with the commercial landlord, allowing lease expenses to scale down during broader economic downturns or localized revenue contraction. Furthermore, asset owners insert explicit protective provisions like co-tenancy clauses directly into lease contracts. These clauses guarantee that if major corporate anchor tenants close or foot traffic falls below specific thresholds, your rent automatically scales down to mitigate tenant loss. On the capital structure side, maintaining a strict debt service coverage ratio, or DSCR, well above 1.5 times is non-negotiable for surviving sudden cash flow interruptions. Before taking any personal equity distributions or treating initial accounting profits as disposable earnings, operators must reserve a dedicated, non-touchable CAPEX fund. This ring-fence reserve guarantees that when mandatory multi-$100,000 equipment updates or leasehold improvements arrive in year 4 or 5, the business can self-fund the upgrade without taking on predatory debt or triggering a franchise default. This is just an illustrative example to help you understand the power of long-term compounding. Your actual results will depend on your income, expenses, returns, and investment choices. Whether you are auditing a multi-million-dollar commercial lease or evaluating a local business venture, the laws of financial gravity remain unchanged. If you value institutional-grade financial autopsies over get-rich-quick narratives, hit the subscribe button. Leave your thoughts in the comments below and share this video with fellow asset owners. Until next time, stay vigilant on your balance sheet.